Now, Uber is a global tech company that connects users to services such as ride-hailing, food delivery, package delivery through their mobile app and platform, and they operate in over 70 countries worldwide. When we take a look at the share price, they are down over the last month around negative 13%, although we can see a nice rebound today. And we want to understand, has this company been severely punished by the market? A bit of an overreaction. Right now, it is trading towards its 52-week lows with a double buy signal. Wall Street, in fact, 4.44, not far off the 4.5 to give it a strong buy rating. And the metrics do look very favorable at a first glance. Valuation B-, growth A+, and profitability A+, all three that we will take a look in some detail today. First thing though, before we even touch this company, we need to understand what are the issues that have led to the company declining over the more recent period. And we need to go to September this year, where Uber as well as Waymo announced a partnership which will be expanding to bring in autonomous ride-hailing to Austin and Atlanta. Now, for those that don't know, Waymo, essentially a project of Google, they develop self-driving cars and operate a commercial robotaxi service. So what did they announce? Well, they said in the beginning of early 2025, they will come together to use the autonomous ride-hailing on the Uber app, where they will essentially manage and dispatch a fleet of Waymo's fully autonomous all-electric vehicles. So why has that caused an issue? Well, just a few months later, essentially released just last week, Uber stock started to fall, and we noticed this is because Waymo are expanding to Florida. Now, that should be good news if they are continuing their partnership. However, one piece of key information here is that the expansion into Miami isn't going to be one they are moving forwards with Uber. In fact, they are doing this through a new partnership with Move, which ultimately isn't good news for Uber, as this was anticipated to be a partnership that would have taken place all across the US. And it wasn't just shares of the company that were down. We also saw Lyft, another very similar company to Uber, driving even lower. The company itself was down 6.4% to $67, as we have seen. In fact, this went down to around $60 just yesterday. Now, fresh information for why we get another drop to this company is that General Motors have exited the Robotaxi market, and explained the reason for this by Gene Munster, a well-known tech analyst. He said that this news is good for both Tesla as well as Google. However, bad news, in fact more bad news, as we saw over the last few weeks for Uber and Lyft. General Motors shutting down their robotaxi efforts because they can't afford the investment, and it is getting a lot more competitive. Now, he has concluded by saying this is further evidence that the robotaxi market will be winner takes all rather than a lot more companies in the space. The likely winners, Tesla and Waymo; the losers anticipated to be Uber and Lyft, and that is ultimately why we do see the share price of this company down over the last month, and in fact quite some way away from its all-time highs that we saw at $87 in 2024. Now, we can see some good news for Uber. In fact, just last week, they did announce their autonomous mobility service in Abu Dhabi. And as we can see, this launch represents the first time autonomous vehicles are available on the platform outside of the US. Now, this is very positive as they are expanding, but the main question you need to have over your heads with Uber is, do you believe over not just the shorter term, but also the longer term, this is one with the anticipation that robotaxis will be entering the market, will aid Uber to move forwards, or in fact, will it stifle their growth and ultimately cause the end of an era for this company? Now, let's just go back to the actual performance of this company. Year to date, as we can see, pretty much minimal movement, up 2%. Over the last 5 years, however, it is up 119%, outperforming the S&P. We've already highlighted trading towards its 52-week lows, and the forward P, as we will come to see, is trading fairly high now at 32.5, but we anticipate with earnings increasing, this will come down, making it a lot more reasonable. Now, speaking of their earnings, how strong of a quarter did they have? Well, we can see they beat Wall Street's expectations, not just on the earnings per share, but also the revenue. In fact, their top line was up 20% in comparison to the same quarter last year. And for those that want to see the exact numbers, well, it was a very, very big EPS beat, $1.20 versus the 41 the market anticipated, 11.2 billion, higher than the 10.98. And we can also see that is reflected on their bottom line, $2.6 billion, which is $221 million higher than the same quarter last year. Other key metrics that Wall Street like to look at, as well as the company itself, some of their key performance indicators, we can see that their trips booked are up. This is again the same quarter comparison, 17%. The monthly active users up double digits, the gross booking up double digits, their income up triple digits, and one area that we do like to focus on this channel is that free cash flow up 133%. Now the earnings analysis doesn't just stop there, as we can see over the next 4 quarters, they are anticipating a bit of an inconsistency in comparison. However, over the last 4, they have a 75% track record, 3 out of 4 beats. The most recent one, as we saw, was fairly sizable. And in turn, over the next full year, $2.31 is what they expect, and we can see that will lower the forward P to 26.49. Again, depends on if you have faith on their estimations moving forwards. We also want to track how their metrics are for the underlying company. Does it reflect a high quality stock? And we want to draw your attention, as always on the channel, to the free cash flow over the earnings, as the earnings is susceptible to manipulation by management through accounting. With the free cash flow, what we do like is, even though it has been negative for the vast majority of the last 10, it has been improving year on year, and we like to see on the trailing 12-month growth noted from the previous year. Over the next 12 months, growth is anticipated to continue in the upward trajectory that we do want to see. In terms of sales growth, while 3 to 7% is typically the bare minimum, in fact 3 to 4% on every metric just to keep up in line with inflation. And what we notice over the last few years, looking very good, 17% on a trailing 12 month. No surprises, this 14% dip given COVID, given the lockdown, people being restricted to use those Uber services. And from a numerical perspective, we see nearly 10 times growth just from 2016 to 2023. Although, as always, we do highlight shares outstanding. We want companies that effectively do share buybacks, returning excess cash to investor pockets. They have, however, done the opposite, diluted your position, something we would say to keep an eye on. But if a company dilutes your position at a very rapid rate, but at the same time can continually massively outperform the S&P 500 in terms of performance, maybe not something you would be too bothered about. The ROIC, very important metric, 10% or more, give us faith management are able to effectively allocate their capital. Not something we get until a trailing 12 month at around 9%. As we will come to highlight, this company hasn't actually reported a net income that consistently, so something again to consider, maybe something to factor in when we look at our margin of safety based on the DCF model later on. Operating margin, we want to see 2 things here. One, we want to see above the minimum 12 to 16%, not something we see. And we also want to see efficiencies, margins improving over the longer term. Again, not something we see on a consistent basis, but only recently they have been able to turn the corner with a profit. So definitely something we would say to keep our eye on. Pretty much the same comments to be mirrored on the free cash flow margin, although 2023 and the trailing 12 month do look promising at 15% as well. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, this correlates to the balance sheet strength, and we want to see below 3. Each of these numbers represent the number of years it would take the company to pay off all of their debt net of cash on hand. 0.66 on a trailing 12 month is very strong, which does indicate that there are no red flag indicators here, but as always we will highlight that through the balance sheet review. We also want to let you know we have just released our latest free weekly article where we talk about one stock we are buying significantly in the month of December. Now we release a copy every single Monday morning where we highlight severely undervalued stocks as well as what's gone on in the market. So click below, you can sign up and start reading straight away. You'll also be able to gain access to 28 undervalued dividend stocks, lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, a recently released copy of 29 undervalued stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and start reading straight away. Now, other parts of our analysis include reviewing insider ownership at 3.84%. We can see 86 million worth of sales over the last year, with the most recent quarter at 2 million. Now we will show you for transparency who these insiders are, but remember, insider selling isn't something we particularly consider a bearish signal. They sell for many reasons, personal or financial. Most recent, 25th, we can see around 28,000 shares sold, netting them $2 million. Now, we do a similar analysis on the institutions with 80% ownership, 10.4 billion worth of sales over the last year, with more buying at around 16.5 during the same time frame. Although we can see pretty much in 2024 as well as the last 4 quarters, institutions are buying a lot more shares of Uber than they are selling, so they do seem to be fairly bullish. But do remember, never copy what they do blindly. Always do your own due diligence. Now, we want to highlight the income statement, in particular the bottom line. As we've already covered, their top line growth has been fairly strong just over the more recent period. When we look at their bottom line net income, we want to understand, does it give a similar story to their top line growth? And the answer is no. We already mentioned not many years of positive bottom line net income. In fact, quite a number of years of a net loss. They've gone from 370 million loss in 2016 to 1.9 billion in 2023. What we would say, however, nice to see on a trailing 12-month, pretty much more than double the previous year. So we do anticipate 2024 to be a strong year for Uber. The main question we want to ask ourselves is, can they keep up this consistency over the longer term? Now, we also want to highlight the balance sheet for a quick health check. Total cash versus total debt, which, as we can see, very inconsistent over the longer term. It's gone from around 6.3 million up around 50% to just over 9 in the latest quarter. And as always, we never look at one of these numbers in isolation. It won't tell us anything. So we compare it numerically and directionally to their total debt, which has only been increasing over the longer term, going from 3 billion in 2016 to 13.3 in the latest quarter. Now, as we saw, net debt to EBITDA does look fairly strong on a trailing 12-month at 0.66, and the cash position isn't far off the total debt. So right now, there are no red flag indicators that we do want to highlight, but you can consider these in your investment thesis and in your margin of safety. In terms of the cash flow and the cash from operations, again, inconsistency over the longer term, but we do notice some nice growth, not only from 22 to 2023, where we can see it going from 642 million to 3.6 billion, but on a trailing 12-month around 6.2, all pointing to signs that 2024 should be a strong year for Uber. Then we move on to some gradings. The first one is the valuation, where they get a B-. In terms of the P on a non-GAAP basis at 22, that is around the sector median at 21.13. So if you are buying this company, you're not really getting a discount or paying a premium to the overall sector. However, if you look at other metrics like the EV to EBITDA, the EV to EBIT, the price to sales, and others, it does look like this company is trading at quite a strong premium. Will depend on which valuation metric you do want to use, but overall it gets the B- rating. Then we move on to the growth, where they get an A+, pretty much telling us they deserve to be trading at a premium. 17% growth over the last 12 months, 4% in terms of the sector comparative, 17% over the next 12, 5.5 the sector comparative, and we can see one of the metrics we pay close attention to, the earnings per share anticipated growth over the next 3 to 5 years, 41%, a lot higher than the sector comparative at 11.5. Again, another possible signal it deserves to trade at a premium. Profitability A+, gross margin 33%, not far off the sector at 32. Their bottom line 10.5, a lot better than the sector at 6.52. But the one point here that really stands out is their cash generated from operations, A+, 6.2 billion versus the sector median at 338 million. Now, quick recap before we jump into the essential DCF model, the valuation process. Double buy signal from Wall Street and Seeking Alpha, Quant giving it a hold. Now, two things to note. One, Wall Street not far off the strong buy, and the second one, Quant at 3.5 would turn this into a buy, so they're also not far away. Valuation, we got a B-, A+ on growth, and an A+ on profitability. Two more things. First one, comparisons against others in the sector of a similar size. We get to see here over the last year, they're down around 2%, not great at all. But when we do look at others in the similar industry, some have also performed fairly poorly, but we do get others like Grab that has performed very strongly, up 75% just over the last 12 months. When we expand it to over the last 5 years, we can actually see Uber looking very strongly in comparison to others at 119%, which whilst is very strong over a 5-year period, we need to remember that past performance is not an indicator of the future. They could perform a lot better. They could perform very poor. Final thing, as a quick reminder, comparison against the S&P, which has outperformed over the last year. However, when we look over the last 5 years, Uber has marginally outperformed. Remember, as always, if you are picking individual stocks, you need to have that faith they will outperform. Otherwise, you may as well invest in a low-cost ETF that tracks the S&P. Now let's jump into the valuation model. As you can see, we get to $93 derived from the DCF model. We'll show you how we got to that value. In fact, our free cash flow year on year, average growth, very high. We've gone a lot more conservative around analyst targets at 12%. With the discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $93 indicating 50% upside right now. So if you see this company growing their free cash flow at that rate, it could look like a very strong contender for the portfolio. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Uber or any others. But for full transparency, we will show you here 10% indicating $82, 33% upside, and those are a lot more bullish, 14%, $106, 71%. Now we'll take through the medium rate, where we do always add a margin of safety. We apply 10% at the bare minimum, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, we'll buy at around $84. Then we pretty much keep going to this near the current trading price to tell us that it does look to have a very nice MOS. At around 30%, a buy at $65. At 35, not quite there yet. So for Uber Technologies, around 30 to 35% MOS. With Wall Street, very bullish. We saw not far off a strong buy rating. $96 is their price target. 55% upside is what they see over the next year. But there are some bearish catalysts just to consider with this company. Over the long term, if you are someone who's very bullish in terms of Tesla and what they will bring to the world in terms of the autonomous driving, other autonomous capabilities, then this company may be one that either isn't right for your portfolio, or in fact you need a much larger margin of safety just to consider some of those potential issues. Now, I would be very keen, especially on this company, to hear your thoughts about autonomous ways of driving, whether Uber will actually be a benefactor, or like Gene Munster said, they will be one of the losers alongside Lyft in a world where it is run by Waymo as well as Tesla. Now, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do talk about our weekly buys and sells. And as always, look, have a great day, and we'll see you all on the next one.